Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Now, every week around this time, we also bring you research from Bloomberg NEF. It is new energy finance, and it's powered by data sets and models, and it looks at things like commodities, power, transport, industry buildings, ag sectors, and it talks about how businesses and governments can finance and navigate change and as we transition to a green energy future. And so today we're going to take a look at U.S. oil supply and basically global oil supply, really. There is a falling rig count. And the question is, does that mean we're going to see falling oil production? And if not, why? Joining us now in the Interactive Broker studio is Tai Liu, global oil supply specialist over at Bloomberg BNEF. So Tai, walk us through sort of the picture when it comes to how many wells we have. Just set the stage for us.
Yeah. So I think the declining rig count in the U.S. that we've seen, it's not going to have that big of an impact as it seems, as much as the headline number suggests. And part of the reason is because, like, if you look at the Permian, where we have the biggest oil production region in the U.S., the well completions is only done about 4.5%. Compared to the rig count, which is down about 15%. And so, and on top of that, you have a lot of efficiency gains in the sector. So you are able to complete a lot more wells with much fewer frac crews across the industry. So I think the rig count number could be a little bit misleading if you're focusing too much on that.
So I'm surprised just looking at your report here and seeing how production in the U.S. continues to increase, but maybe at a slower rate. I don't know. I got WTI crude oil at $77. Why don't I drill some more? I can make money. I mean, it only costs those guys $40 or $50 to get it out of the ground, right?
Yeah, for sure. Yeah, so when we look at the break-evens, especially in the Permian, it's probably around in the low to mid-40s for the Midland Basin. And then for the Delaware Basin, it's probably even lower than that because they produce a lot more gas. But part of the reason is because the U.S. oil patch has really pivoted and transformed itself in the past couple of years. Now, before the pandemic, oil producers were very much focused on production growth. But after the pandemic, the industry has changed, and now they're focusing on financial returns. Now, in order to improve their financial returns, they have to become more efficient. So in the past few years, you have seen a lot of cost-cutting initiatives, a lot of optimizations on logistics and supply chains, a lot of investments in infrastructures. So the entire industry has become a lot more efficient in the past couple of years. And on top of that, they have also become a lot more resilient. And what that means is that nowadays, the U.S. oil industry can produce a lot more oil with much lower capital investments compared to just 5 years ago.
Also, what are the cool things that oil companies are doing to extract more oil out of rock at the end of the day? I mean, I went to a conference about a year ago, and everyone was like, ooh, 3-mile laterals. And what that means is that you basically drill a pipe down, and then you drill it across the rock, basically lateral, and you fracture it. And the longer you go, in theory, the more rock you'll be able to access, and then in theory, the more oil you'll get out of that rock.
Wow. That is good.
Was that too nerdy for you?
No, I learned something.
No, okay, cool.
I learned that fracking is short for fracturing.
Yes.
I didn't know that.
Good job. Ding, ding. We learn things here at Bloomberg Intelligence. So based on that, what are the cool technologies that are coming up that's going to enable even more oil to come out of the rock?
Yeah, so during these longer laterals, it's definitely a big part of these efficiency gains because you are reducing a lot of the service costs when you're drilling longer laterals. And like you said, Alix, you're making a lot more contact with the source rock, so you can pull out a lot more resources from the same wellhead. Some of these, better practices would be having a lot more building out the water handling infrastructure. Some of them would be optimizing your frac designs. Some of them would be, optimizing your spacing between the wells. So a lot of these seemingly small things individually, when they add together, they can have a big impact, especially over time. For example, one of the big producers in the Permian, I was looking at the data, and they were able to reduce their well cost per lateral foot by about 30% between 2019 and 2024. So that's a huge gain in terms of percentage.
All right, so I thought if you go into you find some shale somewhere. Don't you do your good wells, your easy wells first, and then shouldn't the productivity decline over time?
Yeah, that's exactly pretty much what we've seen. Like you said, in the U.S., the oil and gas companies, what they do is they drill the best acreage first because they want to realize the net present value of those better wells. When we look at the data for the past 5 years, what we've seen is that oil production on a well level basis has been declining every year for the past 3-4 years, pretty much across the board. But what's interesting is that in 2024, the data that are coming in so far is they're looking different. Oil production on a well level basis is actually better for the wells that came online in 2024 compared to those last year. So what that means is that technology improvements could be turning back the tide for this production decline on a well level basis.
Which is why it's so cool. When we talk about laterals, now we're talking about 3 miles. That's a lot, and a lot can go wrong in 3 miles. Now, just about 5 years ago, the talk was like, ooh, well, if you frack here, then you're going to hurt the rock over here, and then it's going to mess up the oil distribution and all that kind of stuff. What are the problems that are emerging the longer out we go in these rocks?
I think one of the biggest risk factors, like you said, if something goes wrong, Alix, you lose production from a 3 mile worth of lateral. Yeah. So that's going to be a big opportunity cost for you. But at the same time, if things go right, you can potentially save a lot of money. I think not only they're drilling longer laterals, some of these companies, they're actually making U-turns under the ground, so they can stay within the acreage, and so they can make more contact with the source rock.
But so if you do that, do they U-turn into another layer of the rock, or do they U-turn in the same layer?
They U-turn in the same layer.
Oh my God, that feels like a lot can go wrong there.
Yeah.
But what companies are doing that?
I remember Metadata Resources in the Permian is doing U-turns on the laterals, and there are a couple other ones I don't recall on top of my head.
Oh man. Well, is this nerdy enough for you?
Yeah.
That's really cool.
Well, here's my dumb question of the day.
Never.
Other than shale oil coming from shale, do we still drill old-fashioned rigs and produce oil that way?
We still do that quite a bit. But but if you're talking about onshore, the productivities of these wells is probably like 10%, or maybe 20% of these horizontal wells. So the impact is definitely a lot smaller than the horizontal ones that we do with shales. John Tucker
looks really confused.
Well, no, I'm just saying if I'm Jeb Clampett and you start drilling under my property,
see, Tai doesn't get that reference.
Can you do that? Can you go under my property with your what?
Yeah, you could pay for it.
No, but I'm just saying, can a big oil company go under my land?
They have to pay you for it.
They have to pay you.
Yeah,
yes.
but that's what
prove?
That's what makes shale so unique in the U.S. is because they have to pay you. Like other areas of the world, the people don't make the money. They don't own the mineral rights, and therefore they don't have the same kind of investment in making shale develop. Versus you're like, yeah, you can have it, but you got to pay me, and then you're actually invested in it. But I digress. All right, Tai.
Jeb Clampett was from Beverly Hillbillies.
Again,
thanks a lot. Tai Liu, we appreciate it. BNEF, a global oil supply specialist, joining us on U.S. oil production.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we've got that Brent crude here. We've been calling it out this morning, $81.50 here, up about 3.1%, so a big move. So whenever we see big moves in commodities, we got to get Mike McGlone on the phone. He's a senior commodity strategist for Bloomberg Intelligence. Mike, again, like a lot of us, we woke up this morning and we had to read up and read in on what's happening in Libya. How much is the Libya situation responsible here for this move in global crude?
It's much more positions. Libya exports about 1 million barrels a day. Their average since 2000 was less than that. If they shut off completely, it's way offset what Alix mentioned earlier. Massive oversupply of spare capacity in OPEC. And just look at the U.S. and Canada. Our excess of liquid fuel supply over demand, which is 6 million barrels a day. That was compared to 2008, it was 10 million deficit. So it's insignificant. It's positions that matter. So I look at it as managed money net positions, futures positions, crude oil, which drives that market. were at least a week ago the most sold out in our database going back at least 10 years. I mean, Brent crude hardly ever gets short, and it was. So there's no room for anything but those positions to go up and from buyers to go higher. So to me, that's much more significant. What's happening is we're just kind of normalizing the positions a little bit. And the reason they're sold out is because it's a bear market. And it's just a bear market that's reaching, I think, a short-term bottom.
Not to get too nerdy, but what about differentials? So Libya has a lot of light sweet crude, and there's also dark, and there's medium, and all that stuff. They have light sweet, right? So are we going to see some differential movement in terms of Libya? Like, I appreciate the fact that OPEC Plus has a lot of spare capacity, et cetera, but what do you think we're going to see there?
So, Alex, you know that area a lot better than I do. To me, it's more the macro, and the light or heavy doesn't make much difference. I mean, the one thing that's been significant is that narrowing spread between Brent and WTI. That's one thing that's new is Brent positions are way sold out and WTI positions are normalized. 10% of open interest are net longs, and those are specs. So to me, it's much more the macro, and the macro to me is overwhelming. And I'll bring in an uber big macro. It's what's happening in China. We've seen declining demand, and their bond yields are just plunging for a reason.
So if this move in crude feels a little bit more technical, when do the fundamentals reassert themselves?
Good question. I don't know. I think it's a matter of time. It follows natural gas. Natural gas got to that low price cure, a level that was first traded in 1990 in futures. Now it's around 2. That's just hovering there. Corn's there now. Front corn at 362 was first traded in 1973, 74. It's getting below. It's got to shut off that excess supply. It's coming out. Copper's probably tilting lower. I don't know how long and when it takes. I'm surprised it lasted this long. But one thing that's a bottom line, Paul, is the U.S. stock market has to go up. And that's one thing we've noticed about crude oil in the last maybe 10 years or so. When we have a normal correction in beta, crude oil goes down a lot harder. It's just much more correlated with the stock market now, particularly what's happening in China. So I look at it as a risk is to the downside. It's a matter of time. Right now we have to offset these positions, but the headlines are just overwhelmingly tilting now towards the opposite they were 2 years ago. One is recently oil's hot summer is ending, posing risks for majors in OPEC. Those are macro, which the big shifts. It's the big pendulum shift in commodities is unfavorable for crude oil, and it's on the back of the high price cure.
So when you say that the stock market has to go up, do you mean that it just will go up, or you're saying in order for oil to catch a bid, it has to go up?
Exactly. So prerequisite, I started writing about this a few years ago, is it's the inordinate burden on commodities for stocks to go up because the correlations are just going up and up and up. And at least historically, they are. So though I look at right now, if you're managing crude oil, if you have positions on crude oil, you know, okay, positions are short. It's okay to be, I don't want to run to be, positions are sold out. I can be long here a little bit. But you have to look over in your value at risk model. You have to say, okay, as long as S&P 500 stays stable, I'll stay stable. If you get a little 5% correction, crude oil dropped 20%. Now, it didn't on that last thing on October 5th because they were sold out. But now it's starting to normalize. So it's just the way markets work now.
Hey, Mike, how about gold? Earlier this morning, we were speaking with Dennis Gardman, the former editor of the Gardman Letter and an avowed gold bull for a long period of time here. Give us your gold call here, which I'm sure is going to be very consistent with what I've known you for these many years.
I would consider Dennis a friend, and I do appreciate in the past you remember one of the few things I've been getting right, and that's gold. The problem is, and so I'm still quite bullish gold. It's the only major commodity go up, and I think the notable mention is the Bloomberg Commodity Index is down 30% since its peak in 2022, and gold's up 30% over the same frame. But it's the fundamentals that are still very bullish for gold. Deepest pockets on the planet, central banks are still buying. ETFs, which have had significant outflows, are just starting to turn upward. And then you just look at the very expensive U.S. stock market and U.S. debt to GDP. It's just fiscal spending is off the charts, and neither of the candidates are addressing that. So to me, gold is that trade that's looking for the normal recession to kick in, the yield curve, the U.S. yield curve that's disinvert at some point, just the normal cycles, unemployment going up, and gold's kind of just ahead of that trade. You
know, when I was covering gold back in the day, though, it was very much of a inflation goes up, you want to buy gold. It goes down, you want to sell gold. Central banks are buying not because of the macro, but because they have like a percentage they need to diversify, which is not necessarily based on macro headwinds or tailwinds. Is that still true?
The questions are the same, Alex. The answers have changed. And in terms of any other currency, I think that was initially from Einstein a long time ago. But it's the in terms of any melting currency, sure, gold's a great place to park your wealth. But in terms of U.S. dollars, it's the world's shifting now, and it has a high correlation between that rising debt to GDP. I just published that this morning. And key thing I'm concerned about is the number 643. 643, here's one for you, is the number of bushels of corn equal to an ounce of gold. That's the highest ever. That's where we are right now. So gold's getting expensive, but it's showing you what happens with the store of value, global liquid assets going upward, and that's gold, and elastic commodities like crude oil and corn going down because humans can create more of it with less of it every day. So gold to me is running ahead of what I see happening with, Ira Jersey says, a hard landing, lower U.S. interest rates, probably following China, and at some point a little bit of back and fill in the U.S. stock market, which used to happen in bull markets.
All right, here's the dumb question you're going to get of the day, no question. How do you value a commodity? Like on a stock, I can say price to earnings ratio. On a bond, I can say relative to treasuries. Is gold, when you say gold's expensive or gold's cheap?
So gold's different from most commodities. You use stocks to use. What are the stocks versus the use? So stocks to use for all the grains, and particularly crude oil, is very high. There's a lot of stocks, and there's more and more created. And what's that trend? Gold typically sticks with the more macroeconomic. I like to use, to me right now, it's interest rates, U.S. interest, the trend in interest rates, debt to GDP, and much more macro. How is it relative to the stock market? And here's one I like to end with. One of my most enduring charts I've looked at for decades is the S&P 500 divided by the per ounces prices of gold. Historically, gold's just very cheap. And historically, when you go to recessions, the Fed eases, unemployment goes up, that wide disparity just kind of narrows a little bit. And that's the thing. It hasn't narrowed too much because gold's catching up. And actually, it is narrowing a little bit because gold on a 1, 2, and 3 year basis is outperforming the S&P 500 total return. The risk is it just catches up more.
Bitcoin, how you feeling?
It's it's the last big trade, and it's not the next big trade. So the LBT is no longer the NBT. It's Bitcoin is just overdone. It's stretched. Everything that's happening in Bitcoin were things we were hoping would happen. That is, it's into the mainstream. We have a former president who's embraced it because he wants to get elected. We have the ETFs, and now everybody it's in the mainstream. The thing is also it's showing divergent weakness versus what it should versus beta. So since it made its peak in March, it's declining versus gold versus the stock market. So that's a problem. I think the fastest horse in the race is telling us by showing divergent weakness is the race might be over. So I'm somewhat more defensive on Bitcoin. The key thing I think to remember about Bitcoin, it trades 3 times the volatility of gold and the S&P 500. When the people tell you that, oh, when the stock market goes down and we have a recession, Bitcoin will outperform, I say, well, it usually doesn't work that way with very high volatility assets that are very speculative.
All right.
You go soybeans to Bitcoin to gold to corn.
Corn to gold ratio.
Oh, okay.
Yeah, you got to just, it's a lot. Hey, Mike, we appreciate it. Thank you so much, Mike McGlone, Bloomberg Intelligence, senior commodity strategist, joining us on all the things commodity related.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's go back to the trade situation here. So the latest news is that Canada is going to hit China with tariffs on EVs and steel. Brian Platt, Government News, Canadian government reporter, Bloomberg News, Canadian government reporter, I got that, is joining us now on that from Ottawa. Hey, Brian, what is this about? Is this about Canada wanting to compete more in EVs and steel, or is this about making sure that those things can't come through Canada into the U.S.?
Honestly, I would say it's about both. Canada has put a lot of effort into attracting EV manufacturing. And so for sure, Prime Minister Justin Trudeau's government wants to make sure that those factories and investments and what they want to attract in the future is not undermined by China. But absolutely, this is about Canada's relationship with the U.S. as well. And the last thing Canada wants is for the U.S. to see Canada as a weak point, right? As a potential side door for Chinese EVs. And so I think it's really about both things, but especially that Canada-US relationship.
What's the support level amongst Canadians for just tariffs in general? Because a lot of folks will tell you, hey, this is just a tax on consumers.
Yeah, there will be some pushback on this, but I think generally there's a political consensus that these tariffs are necessary. And again, it's for both reasons, right? I mean, Canada wants its own manufacturing sector, especially that share of the auto manufacturing sector, in especially electorally important regions around Toronto and Southern Ontario. That's where those factories tend to be. And so I think there's a lot of support for protecting those jobs. But Canadians also understand that Canada's got to make sure it doesn't get too far offside with the U.S. I'm sure there will be some people who are concerned that this will make EVs more expensive at a time when it's hard to get to consumer adoption of EVs is not as high as a lot of environmentalists, especially, would want it to be. But I think generally you'll see a lot of consensus in support of this.
Does Canada buy a lot of China EVs at the end of the day, though?
Right now, it's basically Tesla's being manufactured in Shanghai. That's at the moment, that is the only significant inflow of Chinese-made EVs into Canada. I suspect Tesla will move that production to other factories to avoid these tariffs. But we know that BYD in particular, the giant Chinese automaker, is looking around. They've hired lobbyists in Ottawa to look at possible opportunities to build and or sell in Canada. So Canada's trying to get ahead of that. But at the moment, it's basically just Teslas.
Brian, what is, just in terms of the EV, what's the adoption been like in Canada? Because here in the U.S., it seems to have hit a kind of a rough patch, a little bump in the road here in terms of adoption. How is it in Canada?
It's pretty similar, I would say, to the U.S. Canadians, the very popular vehicles here tend to be SUVs and trucks. And I don't think that, from what I've seen, there's not a lot of EV adoption in that space yet. It's pretty similar to the U.S. I will say there are a couple of provinces, Quebec and British Columbia, who EV adoption is higher in those provinces because those provinces were pretty early at rolling out consumer incentives and sales mandates. So some regions of the country have seen higher adoption than others.
That's interesting. Is there going to be more? Is this the beginning or is this the end?
I do think this is the beginning. And in fact, today Trudeau announced there will also be a consultation on other products. Basically, again, sort of following what what U.S. President Joe Biden announced earlier. So I think the consultation that will start now on other potential tariffs will focus on solar cells, semiconductors, critical minerals. I suspect we will see more tariffs in the near future.
All right, Brian, thank you so much for joining us. Brian Platt, he's a Canadian government reporter for Bloomberg News, joining us from Canada. So we appreciate getting the boots on the ground perspective there. But again, seems like, as Brian was reporting there, that this is, as much a political move from Canada to maintain, a lockstep policy with that of the U.S. as it relates to China.
Right, because if you think about it, the U.S. can have all the tariffs that they want, but if there are no tariffs between Canada and China and Mexico and China, there's no reason they just can't move them into those countries, and then they don't get the tariffs when they come to the U.S. So if this avoids it now, Mexico kind of has to do the same thing, or else we run that risk as well.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, "Alexa, play Bloomberg 1130.
We also love talking about ETF flows. Eric Balchunas is probably on vacation, although I saw a license plate.
No,
He's here?
Yeah, we had him in this morning.
I saw a license plate yesterday. We were playing the license plate game coming back from Connecticut. It had ETF in it. And I was like,
really?
Is that Eric Balchunas' car?
Exactly.
I mean, maybe. It could also be Sean O'Hara's car. He's president of Pacer ETFs. And he's joining us now to talk some more about flows. Hey, Sean, does your license plate have ETF in it?
No, it does not.
Oh, it would have been so perfect.
It might have Cal Z.
Cal Z, nice. Okay, so I've been reading a lot about where the flows are going, where the funds are going. There's still record amounts of money in money market funds just sitting there in cash. Are you noticing any of that coming into ETFs, and where are the flows?
Well, thanks for having me. It's been a little bit slow here for August. I think, in talking to some of my friends around the industry, I think things have slowed down. I would expect that, once we get past this weekend, things will pick back up. A lot of the flows early in the year were to the big, broad market cap weighted indexes. The big risk there, I think you guys were talking about coming up, is that there's such a high concentration of the return on the S&P 500, for example, or the NASDAQ 100, that is attributable to 5 to 7 names. And that happens from time to time, but it never really lasts. And so I think you're seeing, going to see flows away from traditional market cap as this market develops a little bit of breadth into different weighting schemes.
Sean, we had an eventful day, certainly on Friday. Fed Chairman Jay Powell out in Jackson Hole in his speech. What did you make of that speech, and what do you think it means for the markets?
Well, I think what I'm hopeful it means is that they're going to stay true to their word. I mean, they have not really deviated from what their message is. I think they're indicating now that they're going to have a cut. I would expect it to be 25 basis points, and then I would expect another cut perhaps later this year to sort of deal with a little bit of the slowdown that's occurring. Hopefully, they're able to engineer a soft landing as opposed to a crash landing. And so their strategy has been all along to be very, very tight on money until they felt like inflation was under control. I think they feel like that's the case now, and we're starting to see a little bit of a crack here and there in the labor market. And so that's their secondary concern, which is why I think they'll cut rates just a little. And I think the market, depending on what their message is, and if for example, they did 50 basis points, I think it would scare the market. So if they do 25, I think that the market will view that as a positive and continue to go up and forward from here.
So based on that, then, do you see the flows into more of the let me go buy super cool tech on a dip flows, or is it let's just rotate into some defensives in case the Fed's going to have to cut 50 basis points?
Yeah, I mean, I think you've seen some of that. I mean, our big calling card is value. We think we redefined value with our Cash Cow series, and we've had a terrific year there. We have a growth strategy that we just launched Friday, a NASDAQ 100 growth strategy that it takes a bit of a different take. For that side of the equation, we use free cash flow margin, which just is a measure of how much free cash flow a company generates based on the sales that they make. And so, and we're optimistic that, the success we've had on the value side, we can have on the growth side with a couple of those ETFs out there right now. And then one more important point is some of the flows we've been seeing here recently have been into risk management strategies. I think people are starting to get a little bit more positioned to, if it's not a soft landing and the economy really does go into a recession, how do I position my portfolio to manage the downside?
Gold higher yet again today. Sean, how do you see that extraordinary outperformance of gold in your ETF world?
Well, I mean, the big ETFs there have taken in some money for sure. I think traditional gold investors would rather, stack it, as they say, right? Keep it in a safe or store it somewhere in a safety box. I don't really think gold as an investment is a good long-term investment. It hasn't been historically a very high returning asset, although it goes through periods when you have a lot of uncertainty where it does tend to move a bit. And so I think that what's going on with the gold trade has been driven primarily by two things. One is people see it as an inflation hedge, and then there are also people that see it as a hedge against sort of a disaster.
Right. And which brings us to Bitcoin, too. What kind of flows are we noticing into the ETFs right now in the crypto space?
Yeah, well, we don't have anything in the crypto space. I'm not sure we're big believers in it.
Okay.
But I will tell you, just if you're from a market observer, there's been enormous flows into Bitcoin ETFs, which, again, I don't think makes any sense. I mean, if you're going to hold Bitcoin, you don't need to hold it in a wrapper that charges you extra money on an average, daily basis, like an ETF that has a management fee. But there's been a great deal of money flowing into these ETFs. I think there was a lot of anticipation waiting for them to finally get launched. And I think eventually what you'll see in the Bitcoin space is what we've seen in the broad market space. Like when you look at the several different versions of the S&P 500 you can own, they're really all the same. And so I think eventually we're going to wind up seeing a fee war on the Bitcoin side.
Interesting.
So the ETF business, Sean, I mean, I'm just looking at some of the research from Eric Balchunas from Bloomberg Intelligence showing, the big players just dominating in terms of total assets, the vanguards of the world. Is that a healthy market structure for any market?
Well, I think generally speaking, it's not a bad thing. I think, the bulk of the ETF assets so far have been in what we would call cheap beta replication strategies, taking an existing broad index and just putting it in the ETF wrapper. So it adds some utility, if you will. You can own the whole market, for example, like the S&P 500. I think there's a very, very good use case for that in people's portfolios. And it presents a challenge for folks like us, which, we're right across the street from Vanguard, so we're fully aware of who they are. We tend to build product that we think is innovative, disruptive, or unique. And I think there's plenty of room for folks like us in this business. We always focus on an outcome in mind or a customer in mind. Like, is this something that would be useful in their portfolio that's not out there? And we either try to design ETFs that are stretching for extra return or creating alpha or managing risk to the downside. And there's a place for that in people's portfolios as well. So I think the ecosystem in general has been very, very healthy. I think that, that if you're not in that $1 trillion plus category, then you're in the bottom 85% of issuers in terms of dollars. But I think as an ETF issuer, I think we're almost $47 billion today. We've grown almost 9 or 10 billion so far year to date, which puts us at like 6 or 7 in terms of year to date net flows. I think we can continue to chug along alongside of those folks and add value for financial advisors and investors going forward.
Before we let you go, we have like 30 seconds. Have you seen anything in terms of people betting on election outcomes or anything like that? Or any ETFs that you see there?
I have not seen anything yet. I think what you'll see is as we get closer, I think you'll see people trying to play that angle, if you will. I mean, there's a pretty diverse philosophy between the two candidates, if you will. One is a little more less regulation, less tax. One is more government. And so I think as we get closer to the election date and we see and people start to feel like whether or not there's going to be a clear winner, you may see some people betting with sector exposures, for example, as a way to play the election odds.
All right. We appreciate that. Thanks so much, Sean. Sean O'Hara, president of Pacer ETFs.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's go macro here. So every once in a while, I love checking in with the real economy folks, or the companies that move the things all around the world. And to me, they're such a great indicator of what's happening on the supply and demand front. For that, we're going to start with Gene Seroka, Executive Director of the Port of Los Angeles. Hey, Gene, just on a basic question here, last week I was really struck with the 2 rail lines coming off line because of strikes. Operations have kicked back once the Canadian government came in. There are still some that are striking now. Have you noticed anything? Has anything been diverted to you guys?
Good morning, Alix, and good to have you on the radio side today. No, we haven't seen much. The cargo that's moving from the Trans-Pacific theater in through Canada will pretty much stay in that lane, even with the short disruption we saw last week. The bigger issue for American economy is the cargo that moves north-south. So whether it be auto parts that uses the USMCA agreement to go back and forth, grain, agriculture products, steel, that's what's impacted the most. You may see a couple of shippers in Asia try to book on Trans-Pacific vessels coming down to LA, but it will be very small amounts in an already over demand situation versus the capacity.
Gene, I would think seasonally right here, we'd have retailers, starting to build their inventories for the holiday season. What's the traffic going through your port? What does it look like today versus some prior years?
Yeah, Paul, great to hear from you. We're up 18% year on year off of very modest comps, but we just crossed the 500,000 container unit mark last month, and it's only the 4th time in our history we've had more than 500,000 imports coming through Los Angeles. Big number for us, and it continues the trend that we've seen thus far this year. In addition, exports are now up 14 consecutive months year on year. So the volume as a whole is really great, based mainly on a strong economy and then some geopolitical issues around the world that I'm sure we'll talk about.
Yeah, so Gene, I'm curious, how much are your customers talking about the geopolitics abroad, but also here in the U.S.? Anecdotally, I keep hearing that certain companies are just holding back on investments until we get clarity on who's going to be in the White House. Are you seeing any of that?
In just about every conversation, Alix, it is an election year. And folks are looking to see and try to hedge as to what type of policies will be in place after inauguration. You've got a protracted labor negotiation on the East Coast with the Dock Workers and Employers Association that's coming up for expiry at the end of September. The Panama Canal drought issues have been in the news for well over a year and a half, and the ongoing security concerns in the Red Sea have stymied crossings at the Suez Canal for more than a year as well. All of that put together, fractionally, you see cargo coming to the west coast of the United States and specifically Los Angeles, in addition to the strength of that economy. That shows where the numbers are going.
Hey, Gene, just last week, Bloomberg News published a really in-depth big take story, and it looked at your world ports around seaports around the world and how some governments are using them as really strategic tools here because they're becoming so important for global trade. Just for the U.S., do you feel like our ports are where they need to be in terms of, investments, capacity, or does the U.S., whether it's a public-private partnership, need to invest more?
We absolutely need to invest more, but beginning with the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, and now applications that are in front of the Environmental Protection Agency, we've seen a focus on ports over the last 3.5 years here in the United States that we haven't seen in a generation. We'd like to have this type of federal investment budgeted annually. And I also know that the work here in California under Governor Gavin Newsom has the same bent, paying attention to these ports, investing not only in the infrastructure, but digitalization, as well as clean and green technologies. This has to continue, but I like the trajectory that we're on right now.
Going back to what you were mentioning about customers talking about election uncertainty, what's your best guess as to what happens after that? I'm trying to get a handle on okay, now we know who wins the White House. Are we going to see a flood of money coming in, like a flood of buying, or is it just going to be incremental?
Well, Alix, take away the politics. The presumptive Republican nominee, and now Republican nominee, has said he wants to put a 10% tariff on all $3 trillion worth of imports that come to the United States, 60% on those emanating from China, and potentially 60% on automobiles and other products coming out of Mexico. That would change the landscape here at the Port of Los Angeles forever, and it would create inflation. On the Democratic side, what we've seen is a continuation of this tariff regime and get tough on China policy, but in very small, targeted ways. What happens to investment after this has to revolve around international and trade policy. What are we going to do to stimulate not only the continuation of that government investment, federal and state level, but how we can give confidence to the private sector to invest behind us?
Gene, nobody has a better view of China than you guys in the Port of Los Angeles. Are the boats still coming? Are they loaded as much? Because there's real concern about the Chinese economy.
Yeah, a couple things, Paul. When we concluded calendar year 2022, 57% of our business portfolio here in Los Angeles was China cargo, imports and exports. Right now, it's about 43%, yet we're still growing. We've been nimble enough here in Los Angeles to attract the cargo in Southeast and South Asia. There are more nonstop services being put in place by the shipping lines. Speed has always been our selling point. With cargo coming from Asia and distributing throughout the country, we keep these nonstop services in place. That speed variable remains in our favor.
What's your biggest problem right now, Gene? What keeps you up at night?
Well, looking across the board, making sure we keep our costs in place, and we do that with a relatively expensive landscape on how we move cargo, but more volume means our unit cost becomes much more competitive, and we're trending in that direction nicely. We've got a very complex labor landscape. Our dock workers have a contract for another 5 years, but it's the truckers, warehouses, folks in IT and manufacturing. We've got to keep trained up and moving with this economy. And then lastly, along the regulatory environment, got to make sure the clean air is a priority, but making sure that we're balanced, because every 4 containers here in Los Angeles creates a job.
Interesting. So, Gene, you mentioned some of your partners there, whether they're at the docks, the warehouses, the transportation, the rails and trucks. How is that supply chain? How is that logistic chain performing in your area these days?
I look at the vital statistics every morning, and after just checking in with you all, I saw that they're at or better than where they were pre-COVID, with one exception. Our on-dock rail cargo sitting a little bit longer than I would like. We're working very closely with both the Union Pacific Railroad and BNSF to make sure we have rail cars, engine power, and crewing to match this surge in cargo that we have coming now. Nothing sinister is happening on the ground. Just need to keep that velocity going so the next ships, of which we have 56 on the way from Asia, can be worked expeditiously by our longshore members and then gotten off into the American economy. And that's with all this data, Paul, we see these micro and mini spikes or changes in the supply chain data so we can act much quicker than we ever have before.
All right, Gene, thank you so much for joining us. Gene Seroka, Executive Director, Port of Los Angeles.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.